Andrew, how should advisors analyze the how and why ETFs fit within a portfolio?
Yeah, I think that the industry's done a lot of work of putting active management against passive management and kind of creating them as enemies. I think you've seen a lot of media headlines, so passive's outperformed active, ETFs are taking over the market. I view them as complementary tools. So if I was a plumber, I'd want every single tool in my toolbox. I wouldn't want to be stuck to one sort of tool, because at the end of the day, you don't want to fit a square peg in a round hole. So what we've seen over the past decade, 15 years or so, is that a lot of investors are actually using both. So I don't like to say that ETFs are for one kind of investor and a mutual fund, bottom-up stock picking type investor is fit for another. I think they're actually very complementary in the sense that ETFs, they tend to be very diversified, so you see larger stock holdings on the aggregate. What you see there is an increase in beta. So you get a little bit more sensitivity to market swings, and they also tend to be fully invested, so that's how we've seen that upside participation in bull markets. Then take an active mutual fund, so bottom-up stock selection. Those are the guys that are qualified to say, hey, I think Royal Bank should be overweight relative to CIBC. I think Synovus is a better play than Suncorp, for example. Those are just hypothetical terms. By no means have we actually said any of those things, but they're in the position to actually make those decisions. So they also have the ability to raise cash. So when we talk about downside protection, I think when you look across the Fidelity lineup, we have very good history of downside protection. So if you marry the two products together, you're just expanding your toolkit, and I think that's what we're trying to deliver to investors.
Yeah, I think there's a lot to be said for your point that you just made, which was that there's been way too much time spent arguing about active versus passive. Yeah. In reality, all the passive instruments are being traded very actively. The users of passive ETFs in the market have actually been using them very actively. So this debate about active versus passive is kind of moot. It's kind of it's more of a diversion than an actual issue.
Yeah.
Really, I think the bigger issue is when it comes down to portfolio management, what's your overall cost of getting in and out of these products, getting out of these ETFs, and because that's going to have a far greater impact. The bid-ask spread on an ETF, the MER, the management expense ratio is sort of the fixed cost, but the real costs you should be looking at are the other impacts, the trading impacts, where these products, these ETFs are being used very actively. That seems to be an issue that gets overlooked.
Yeah, I agree with you. I'd say at the forefront, from an asset allocation standpoint, you're making an active decision whether you're going to buy an ETF or a mutual fund. So that decision at the foremost is active in nature.
That's right.
And I think you nailed it on the head. There are mutual funds you trade at the net asset value at the end of the day, so there's no execution cost in terms of getting in and getting out. I think what a lot of investors overlook is the bid-ask spread. So what you want to see when you're trading an ETF is a tight bid-ask spread, because that is, theory is part of your execution cost. It goes beyond the management fee. So let's say a bid-ask spread is 10 basis points wide. That means it costs 5 basis points to get in, 5 basis points to get out. So 10 basis points on your round trip. What we've seen is some of the less liquid ETFs, because at the end of the day, an ETF is as liquid as its underlying securities. So the ETF trading volume is kind of irrelevant. What you see on the exchange, it's how much can the underlying securities in that ETF actually take from a trading volume standpoint. So the less liquid that underlying basket is, that wider the bid-ask spread. So I think you need to look at what you're paying from an execution standpoint as well.